With these episodes, I'm going to help you become such a great stock market investor that stockbrokers are going to start asking for advice. But before I do so, I need you to promise me that number one, don't invest more than what you're willing to lose, okay? And number two, with all this money you can make, don't let it get to your head. All right? Just those two. Now let me take you back in time, in 2008, when the stock market crashed, all right? If you knew then what I know now, you might as well have a ski mask and a black bag and not commit a crime. All right, but the question is, with all these stocks out there, how would we have known what to invest in? Right? Well, shall we begin?
Goblins from Mars, Ryan Oaks. We glowed up. We glowed up. We glowed up. Oh man, look this guy. We are the glowed up. Pulled up, tell 'em pull the curtain. Roll 2, no 3, got a fifth of bourbon. Got foreign bitches that shepherd German. That I want the brain from, I need to learn. And they told us all that we'd end up broke. We sucked it up and we did the most. Now we taking over, we want the globe. So it's to the west to go take the coast. Everyone got shit to say, I tell them grow up. When they try to bring us down, we only go up. We tell them that we in their city, everybody shows up. Oh man, we are the glowed up. We are the glowed up. Boy, we are the glowed up.
All right, guys, as you can see in that portfolio of mine, as a lot of stuff is blurred out for all intents and purposes, but I made 43% in 4 months, okay? But I haven't even shown you guys in 2008 when I made 300%, I was gonna show that, but I can't find the file anymore on my brokerage account. But let me talk about 2 types of stocks, okay? Number 1, core stocks. And number 2, growth stocks, okay? So core stocks are stocks that are mature, that have been there for years, that have proven their worth, okay? For example, Coca-Cola, and Google possibly, right? Yeah, Google's a core stock. They call it a moat. When a company becomes a core stock, it's like a castle, and they have a moat around. It's like a ditch full of water, right? That means, it's an example, like back in the day when it was impenetrable. They couldn't, other companies couldn't compete with it, so it becomes a core stock. And the interesting about core stocks is it gives a lot of dividends, good dividends, okay? And the reason why it does that is because it has expanded so much already that it refuses to overexpand, right? And all the money from revenue that they get every year, every quarter, every day, they're just giving it back to the investors, whether it be quarterly or yearly, okay? So Coca-Cola does that. Coca-Cola is great. The problem with that is it's so expensive. And the reason why it's so expensive is because it's the golden ticket, it's a goose with that lays the golden egg, right? And a lot of people who own those are the billionaires, the millionaires, who just cash in, use the dividend to live life, to buy that yacht, to buy that Ferrari, okay? And let's talk about growth stocks. Growth stocks are up and coming stocks, okay? Maybe just a year or two, maybe 3 after the IPO. And it doesn't give a lot of dividends, if not, if any, because what they do with that money, with that revenue that they get, they reinvest it for expansion, to expand that company, to get bigger and bigger and bigger, right? Now, growth stocks, you don't get a lot of dividends, but you get changes in the value of the stock, right? So that's when it goes from $5, to $20 in a year or two. And for example, now, Facebook is an example of growth stock. And I bought Facebook recently this past December for $100, and now it's at I don't know, 160, 150, 160, right? It's expanding because it's growing, and eventually it will become a core stock if it survives. Not a lot of these companies survive the test of time, but if they do, 20, 30, 40 years down the line, they're overexpanded. They're just going to start to give their revenue and redistribute it back to the shareholders, such as myself or yourself if you have any. Okay? Core stocks are relatively stable. Okay? They're expensive, they're stable. I call that high beta, low yield. Okay, beta it represents stability, yield represents instability. So core stocks are high beta, low yield, and growth stocks are high yield, low beta. And you have to watch the news in order to actually start to see what companies' growth stocks are doing to promote themselves. But don't let the news dictate your decision. Okay, let the news grab your attention, but what dictates your decision should be the facts. All right, a lot of the news out there, I don't know, CNN, Fox, Yahoo Finance, whatever, they're all based on opinions, okay? And the facts you can get from what is called the quarterlies, okay? That's their report card. As soon as a company reaches its IPO, as soon as it becomes public, they're required to have a quarterly and a yearly. What's that? They're required to have a quarterly and a yearly annual report, okay? Quarterly report and an annual report. And that is monitored by the SEC, the Securities Exchange Commission. They make sure that all the numbers out there, and what you'll find there are their gains, their losses, their revenues, the inflow of money and the outflow of money that come in there. The SEC regulates that, specifically the annual, we would call it the 10K, all right? So you read those and you look at those numbers. Those are what should dictate your decisions on whether to buy the stock if you haven't bought it yet, or sell it if you haven't, or hold on to it, okay? And you can find those publicly, right? They're public reports. Anybody can access it. I'll show you here. Let me show you here on. Here it is. Investor.fb.com. Okay. If you do that, investor.fb.com. You're gonna go to, there goes Zach. What's up, Zach? Right? This is the investors page, right? This is intended for what investors get to see in terms of performance, the company's performance. Okay. So right now, I want to look at financials, quarterly earnings, right? And annual reports. Okay, so let's look at your annual report. Don't mind if I do. Earning release, HTML. Yeah, let's do that. Boom. These are reports on costs and expenses, revenues, income from operations, net income, right? This is public. You have access to it. Investor.fb.com. And a lot of companies, public companies, all of them, it should be easily accessible. And if it's not, contact the SEC, or contact them first. Please don't contact the SEC just yet. All right? And ask them for this report. You're an investor. You have every right to. Even if you're not an investor, it's public. You should be able to see it to find out whether you want to invest in it or not. Okay? So there it is. It's accessible. That's called balance sheets. All right? And the reason why this is called balance sheets, it's supposed to be balanced. All right? Their inflow, money in and money out, should be balanced. Okay? Now there are obviously risks, right, in investing in the stock market, but more importantly, there are two types of risks that I'll mention tonight. It is one, systematic risk, and two, non-systematic risk. Okay, and I'll explain right now. Form of systematic risk is economic risk. All right, just like in 2008, I mentioned earlier in the beginning, when the economy collapsed because of the housing market, right? Subprime loans, subprime mortgages, almost every stock nosedived, right? Maybe not all. I'll take that back, and I'll explain in a minute why some may not have. Okay, and when they nosedived, right? This systematic risk, all these stocks went down, right? But it's not necessarily their fault. The reason why they went down is because the investors got scared. You got to understand that the stock market is driven through stock market investors' emotions, not necessarily through logic. But they all read the same reports, annual reports. That's what they base their actions on. Okay. And if you read the quarterly, it nosedive, because not all investors are smart. Investors sell, right? Sell low. But if you look at the balance sheet, and nothing's wrong. Operations are great. The product's great, no issues. It just nosedived because everything else did. That's when you buy. That's when they say, buy low, sell high. Be greedy when people are fearful. At that time, people will be fearful. Okay, but be fearful when people are greedy. Right now, this day and age, right now, September 2017, stock markets are high. They're greedy. They think it's going to go even higher. That's when you get fearful. All right, you got to get ready. Now there's non-systematic risks. That is operations, a bad CEO. For instance, if they're not public, but if Uber was public, that would be considered a non-systematic risk because, poor management, bad culture, and they're hurting right now. Hopefully they can come back. They provided a great value to me, to everyone here who utilize the public that type of transportation. And if you begin to read these annual reports, you'll begin to see the trends as to if that company's doing well or not. okay? And base your decisions on that. I know that's a lot to handle, guys. I'm gonna leave it there. If you guys have any comments, let me know. And next episode, we'll start talking about the balance sheet, what to look for, how to analyze it. Get ready, right? All right, guys, let's make some money.